There is one number in global financial markets right now that investors across the world are watching very closely. It is not a stock price, not the price of oil, and not even the value of gold. It is the volatility index, often called the VIX, a number that reflects how uncertain professional investors believe the next month in financial markets will be. And this week, that number suddenly surged to levels not seen in months. When the VIX rises sharply, it sends a clear message across Wall Street, London, Tokyo, and Hong Kong. It tells investors that something unusual is happening and that the financial system is preparing for a period of serious uncertainty. Right now, global markets are reacting to a sudden combination of geopolitical tension, energy disruption, and financial stress that is moving across every major asset class at the same time. Stock markets around the world have begun to fall together in a way that investors have not seen for many months. Japan's Nikkei dropped more than 3% in a single trading session. China's CSI 300 fell more than 1%. Germany's DAX index dropped over 4%, while the United Kingdom's FTSE markets also moved sharply lower. In the United States, the S&P 500 fell more than 2% in one day, wiping hundreds of billions of dollars from the value of global equities. When economists look at markets during moments like this, they do not focus only on one country. Instead, they watch the broader global picture. One of the most important measures of global equity performance is the MSCI World Index, which tracks developed market stocks across more than 20 countries and represents tens of trillions of dollars in total market value. This week, that index recorded one of its worst single-day drops since the middle of last year. The fact that stock markets in Tokyo, Shanghai, Frankfurt, London, and New York all moved lower in the same trading window tells investors something very important. It suggests that the cause of the decline is not local economic news, but a global shock that is affecting financial markets everywhere at once. At the center of the current market reaction is rising tension in the Middle East and the growing fear that energy supply routes could be disrupted. Energy markets reacted immediately. Oil prices surged sharply in early trading, rising more than 10% at one point before settling slightly lower. Natural gas prices in Europe moved even more dramatically, jumping by more than 50% over just a few trading sessions. These kinds of moves are extremely rare in energy markets, and they send a powerful signal to investors that supply disruptions may not be temporary. The reason energy markets matter so much to global investors is simple. Energy is one of the basic inputs of the modern economy. Every airline ticket, every container ship, every manufacturing plant, and every delivery truck depends on fuel. When energy prices rise suddenly, the cost spreads quickly through supply chains. Companies pay more for transportation, factories pay more for electricity, and eventually those higher costs begin to appear in consumer prices. As a result, financial markets often react quickly when energy disruptions appear. Investors begin calculating what higher energy prices might mean for corporate profits, inflation, and interest rates. That is exactly what appears to be happening now. Traders across global markets are adjusting their expectations for how long the current conflict might last and how severe the economic impact could become. The reaction has been particularly visible in countries that depend heavily on imported energy. South Korea provides a clear example. The country operates one of the world's most advanced manufacturing economies and exports large quantities of semiconductors, electronics, and automobiles. But South Korea imports most of the oil and gas that powers its economy. When energy supply routes in the Middle East appear at risk, South Korean markets often react very quickly. This week, South Korea's main stock index recorded one of its sharpest single-day declines in nearly 2 years. Billions of dollars in market value were erased in just a few hours of trading as investors reassessed the risks facing the global economy. Foreign investors moved money out of local stocks, and the Korean currency weakened slightly against the US dollar as capital flowed toward safer positions. But what made this market reaction especially unusual was not just the decline in stocks. In previous geopolitical crises, investors usually follow a familiar pattern. When uncertainty rises, they often move money into traditional safe assets such as gold. Gold has historically acted as a store of value during periods of conflict or financial instability because it is not tied directly to any single government or currency. Yet something different happened this time. Instead of rising, gold prices actually fell sharply during the market sell-off. The price of gold dropped several percent in just one trading session. Silver prices also declined, falling even more steeply. Mining companies that produce gold and silver experienced even larger losses as their stock prices fell across global exchanges. For many analysts, this movement raised an important question. If investors are worried about global instability, why are traditional safe assets falling instead of rising? The answer appears to be connected to another major shift happening at the same time. While stocks, metals, and bonds were falling, the US dollar began rising strongly against other major currencies. The dollar index, which measures the value of the U.S. currency against a basket of global currencies, recorded its largest daily increase in months. This pattern is extremely important because it reveals how institutional investors are reacting behind the scenes. When the dollar rises while most other assets fall, it often signals that large financial institutions are moving quickly into cash. In other words, they are selling a wide range of investments in order to increase liquidity. Moments like this are sometimes described as deleveraging events. In modern financial markets, many institutions use borrowed money or complex investment structures to amplify returns. When unexpected events disrupt those strategies, investors may need to sell assets quickly in order to reduce risk or meet financial obligations. That process can create a chain reaction where multiple asset classes decline at the same time. Evidence of this process appeared across bond markets as well. Government bonds, which often rise during times of uncertainty, also experienced selling pressure. Traders began adjusting expectations for inflation and interest rates as energy prices moved higher. Rising energy costs can push inflation upward, and that possibility makes investors question whether central banks will be able to lower interest rates in the near future. Only a few weeks ago, many investors believed that global inflation pressures were gradually easing. Bond markets had been rallying as traders anticipated that central banks might eventually begin cutting interest rates again. That optimistic outlook helped drive stock markets to record highs earlier this year. But the sudden rise in energy prices has complicated that narrative. If oil and gas remain elevated for an extended period, inflation could return as a major concern. Higher inflation would make it more difficult for central banks to reduce borrowing costs, and higher interest rates can place pressure on both stock valuations and economic growth. Large financial institutions have begun discussing these risks in research notes sent to clients around the world. Analysts are warning that the economic impact of the current conflict could be larger than previous regional crises if energy infrastructure becomes directly involved. One of the most important concerns involves the possibility that key energy facilities in the Middle East could be disrupted. The region contains several installations that process or export enormous quantities of oil and gas. If even one of these facilities were temporarily damaged or shut down, global energy supply could tighten rapidly. Energy analysts have modeled scenarios where oil prices could rise significantly if shipping routes through the region are interrupted. The Strait of Hormuz, for example, carries a large share of the world's seaborne oil trade. Any disruption in that narrow waterway would immediately affect energy markets worldwide. Investors are now trying to estimate how long the current conflict might last and whether it could affect those critical supply routes. Early reports suggested that tensions might ease quickly, allowing markets to stabilize within days or weeks. But more recent statements from political leaders have suggested that the situation could continue for several weeks, or possibly longer. For financial markets, the difference between a short disruption and a prolonged one is extremely important. A brief spike in energy prices can often be absorbed by companies and consumers. But if high energy costs persist for months, the impact spreads throughout the entire economy. That is why the sudden rise in volatility has attracted so much attention. The VIX is not simply a technical indicator used by traders. It represents the collective expectations of thousands of investors who are constantly evaluating the risks facing global markets. And right now that signal is telling us something significant. Markets are no longer reacting only to headlines about geopolitical events. Instead, investors are beginning to calculate the deeper economic consequences of those events. Will energy prices continue rising? Will inflation return as a serious concern? Will central banks be forced to keep interest rates higher than expected? These are the questions that now dominate conversations across trading floors, investment banks, and asset management firms around the world. But perhaps the most important question of all is still unresolved. Are the sharp market declines we are seeing right now simply a temporary correction caused by uncertainty? Or are they the first signs of a much larger financial shift that could reshape global markets in the months ahead? That is the question investors everywhere are now trying to answer. To understand why global markets are reacting so strongly right now, it is important to step back and look at the deeper financial forces operating beneath the headlines. Market movements rarely happen for only one reason. Instead, they are usually the result of several economic pressures building at the same time until investors suddenly realize that the balance of the system may be changing. Right now, the financial system is facing three powerful forces at once: rising energy prices, uncertain global trade routes, and a fragile inflation outlook are all converging in a way that investors cannot easily ignore. When these forces appear together, they create the kind of uncertainty that can ripple through every asset class, from stocks and bonds to currencies and commodities. Energy prices sit at the center of this story. Over the past decade, the global economy has become extremely sensitive to energy costs. Modern supply chains stretch across continents, and nearly every product depends on transportation. Ships carry raw materials across oceans. trucks move goods across highways, and aircraft transport high-value products across international markets. All of that movement depends on fuel. When oil prices rise sharply, the effect moves through the entire economic system. Airlines face higher operating costs, shipping companies pay more to move cargo, and manufacturing firms must spend more on energy to run factories. Eventually, these higher costs begin to appear in the prices that consumers pay. Right now, investors are watching energy markets very closely because the recent geopolitical tension has created a situation where supply disruptions could happen quickly. The Middle East remains one of the most important energy-producing regions in the world. A large share of global oil exports travels through a few narrow shipping routes, particularly the Strait of Hormuz. This small waterway connects the Persian Gulf to the open ocean, and it handles a significant percentage of the world's seaborne oil shipments. If tanker traffic through this passage were disrupted for even a short period of time, global oil markets would feel the impact almost immediately. Energy traders understand this very well. That is why oil prices often move rapidly whenever tensions rise in that region. Markets are not simply reacting to current supply levels, they are reacting to the risk that supply could suddenly tighten. Higher oil prices create another challenge for financial markets because they influence inflation expectations. Inflation occurs when the overall cost of goods and services rises across the economy. Energy plays a critical role in this process because it affects the cost of producing and transporting nearly everything. Over the past year, many central banks had been cautiously optimistic that inflation pressures were finally easing. After several years of high inflation following the global pandemic and supply chain disruptions, price increases had begun to slow in many economies. That allowed investors to believe that central banks might soon be able to lower interest rates again. Lower interest rates generally support financial markets because they make borrowing cheaper and encourage investment. Companies can expand operations more easily, consumers can finance purchases at lower cost, and stock valuations often rise when interest rates fall. But rising energy prices complicate that outlook. If oil and gas remain expensive, inflation could begin climbing again. Central banks such as the Federal Reserve, the European Central Bank, and others closely monitor inflation data because their main responsibility is to maintain price stability. If inflation starts rising again, these institutions may feel pressure to keep interest rates elevated for longer than investors had expected. This is one reason why bond markets have recently shown signs of stress. Bonds are highly sensitive to interest rate expectations. When investors believe that rates will remain high, bond prices often decline because newly issued bonds will offer higher yields than older ones. That process appears to be unfolding now. As energy prices moved higher and geopolitical risks increased, bond traders began reconsidering the possibility that interest rates might stay elevated well into the future. The result has been a gradual sell-off in government debt across several major markets. Another important factor influencing markets right now is the flow of institutional money. Large investment funds manage enormous pools of capital that move across global markets every day. Pension funds, insurance companies, sovereign wealth funds, and hedge funds constantly adjust their portfolios based on changing economic conditions. These institutions use complex risk models to guide their decisions. When volatility rises and uncertainty increases, those models often instruct portfolio managers to reduce risk exposure. That process can lead to the selling of stocks, commodities, and even precious metals as investors move money into safer and more liquid assets. This helps explain why gold and silver declined during the recent market turbulence. In theory, precious metals often act as safe havens. However, during moments of financial stress when institutions need immediate liquidity, investors sometimes sell gold along with other assets in order to raise cash. That cash frequently flows into the US dollar because the dollar remains the world's primary reserve currency and the most widely used medium for global trade and finance. When the dollar strengthens during periods of market volatility, it can reinforce the selling pressure across other asset classes. A stronger dollar often pushes commodity prices lower because commodities are usually priced in dollars on international markets. At the same time, investors holding foreign currencies may move capital into dollar-denominated assets, further strengthening the currency. This dynamic has become increasingly visible over the past several trading sessions. While many global assets have declined, the dollar has strengthened against a range of other currencies. This movement suggests that investors are prioritizing liquidity and safety while they wait for greater clarity about how the geopolitical situation may evolve. From a broader perspective, markets are now facing two possible paths forward. The first scenario could be described as the bullish outcome. In this scenario, the geopolitical tensions gradually ease over the coming weeks. Energy infrastructure remains intact, and tanker shipments continue moving through critical trade routes without major disruption. Oil prices might remain somewhat elevated for a short time, but eventually stabilize as supply flows normalize. If this outcome unfolds, financial markets could recover relatively quickly. Investors who sold assets during the initial wave of uncertainty might begin buying again once the risk of prolonged disruption fades. Stock markets could regain lost ground, bond markets could stabilize, and precious metals might resume their traditional role as long-term hedges against economic uncertainty. Under this more optimistic scenario, central banks would likely continue monitoring inflation carefully, but might still have room to consider gradual policy easing later in the year if economic conditions permit. The global economy would experience a period of volatility, but the overall growth outlook would remain largely intact. However, there is also a second scenario that investors must consider. In the bearish scenario, the geopolitical situation intensifies or lasts longer than markets currently expect. Energy supply routes could experience intermittent disruptions, and oil prices might remain elevated for a prolonged period. If energy costs continue rising, companies around the world would begin facing higher operating expenses. Those costs would eventually filter through supply chains and into consumer prices. Inflation would begin accelerating again, forcing central banks to keep interest rates higher for longer. Higher borrowing costs could slow economic activity, reduce corporate profits, and place downward pressure on stock valuations. At the same time, financial markets could experience repeated waves of volatility as investors struggle to assess how long the disruptions might continue. Businesses that depend heavily on energy, transportation, or global trade routes would be particularly vulnerable under this scenario. History shows that prolonged energy shocks can have powerful effects on the global economy. Previous oil supply disruptions have triggered recessions, currency instability, and significant financial market corrections. Investors are very aware of this historical pattern, which is why they are reacting so carefully to current developments. But while both scenarios remain possible, there is one critical factor that will likely determine which path global markets ultimately follow. That factor is time. If the current disruption proves brief, markets may recover once uncertainty fades. But if tensions continue long enough to keep energy prices elevated for several weeks or months, the economic consequences could become more structural. Investors across the world are now watching closely for signals that might reveal which direction events are heading. They are monitoring shipping activity, energy infrastructure, diplomatic developments, and statements from political leaders. In financial markets, timing often determines everything. A short shock can be absorbed. A prolonged disruption can reshape the entire economic outlook. And right now, investors are trying to determine which of those outcomes is becoming more likely. Right now, financial markets are entering the most important phase of this entire situation. The first shock has already happened. Investors have seen the sudden rise in volatility, the drop in global stocks, the surge in energy prices, and the unusual movement where the US dollar strengthened while many other assets declined. That first reaction was driven by uncertainty, but what happens next will depend on how several key developments unfold in the coming weeks. Across trading desks in New York, London, Singapore, and Tokyo, investors are now watching a small number of signals that could determine the direction of global markets for the rest of the year. These signals are not hidden. They are visible in energy prices, central bank decisions, shipping routes, and geopolitical developments that affect the global economy. The first and most immediate factor is the price of oil. Oil remains one of the most important commodities in the world economy because it influences transportation, manufacturing, and energy production across nearly every industry. When oil prices rise sharply, the impact spreads quickly through global markets. At the moment, oil prices have already moved significantly higher compared with where they were only weeks ago. Traders are not only reacting to current supply levels, but also to the risk that supply could become constrained if tensions continue. If oil prices continue climbing toward higher levels, the pressure on global inflation will increase. Inflation is a central concern because it directly affects how central banks manage interest rates. Over the past 2 years, central banks around the world have been working to control inflation after the major price increases that followed the pandemic and global supply chain disruptions. Higher interest rates were used as the main tool to slow down demand and stabilize prices. Recently, there had been signs that inflation might be easing. Some investors even began expecting that central banks could eventually start lowering interest rates if economic conditions allowed. But the sudden rise in energy prices has complicated that outlook. If oil and natural gas remain expensive for an extended period, the cost of transportation and production will remain elevated as well. Businesses will eventually pass some of those costs on to consumers. When that happens, inflation can begin rising again even if demand in the economy has not increased significantly. Central banks cannot easily ignore that kind of inflation. If price pressures return, policymakers may have to keep interest rates higher for longer than markets had hoped. Higher interest rates tend to slow borrowing, reduce investment activity, and place downward pressure on stock market valuations. That is why investors are paying very close attention to upcoming statements from central banks, particularly the Federal Reserve in the United States. The Fed's decisions often influence financial conditions across the entire world. because the US dollar plays such a central role in global trade and finance. If the Federal Reserve signals that interest rates will remain elevated for a longer period due to inflation risks, markets could experience additional volatility. On the other hand, if energy prices stabilize and inflation expectations remain contained, policymakers may eventually gain more flexibility in their decisions. Another critical factor that investors are watching involves global trade routes. Modern economies rely heavily on maritime shipping to move goods between continents. Large container ships transport everything from electronics and automobiles to food and raw materials. Any disruption to major shipping lanes can slow global trade and increase transportation costs. The Strait of Hormuz remains one of the most sensitive points in the global energy system because a significant share of the world's oil exports passes through that narrow passage. If tanker traffic continues moving through the strait without interruption, markets may gradually regain confidence that supply flows will remain stable. However, if shipping activity becomes restricted, or if tankers face delays or security concerns, energy markets could react quickly. Even temporary interruptions can create shortages in regional markets and push prices higher. Energy traders understand how sensitive the system can be when supply chains become strained. Investors are also watching geopolitical developments very closely. Diplomatic negotiations, military actions, and political statements can all influence market expectations within hours. Financial markets tend to react not only to what has already happened, but also to what might happen next. For example, if diplomatic efforts succeed in reducing tensions, markets could begin stabilizing almost immediately. Investors would likely view a reduction in conflict risk as a sign that energy supply routes and global trade flows will remain secure. But if the conflict continues or expands, markets could face additional periods of volatility. Prolonged geopolitical tension tends to keep investors cautious because it introduces uncertainty into economic forecasts. Businesses hesitate to make large investments when the global environment appears unstable. Another area that investors are monitoring carefully involves precious metals, such as gold and silver. Although these assets declined during the initial market reaction, their role in the financial system remains significant. Historically, gold has served as a long-term hedge against both inflation and currency instability. If inflation concerns grow due to rising energy prices, some investors may eventually return to precious metals as a way to protect purchasing power. At the same time, if financial stress increases and institutions need liquidity, metals could remain volatile in the short term. Silver in particular often behaves differently from gold because it has both monetary and industrial uses. Silver is widely used in electronics, solar panels, and various manufacturing processes. That means its price is influenced not only by investment demand, but also by expectations about industrial activity. Stock markets will also continue responding to these developments. Equity investors are trying to determine how corporate profits might be affected if energy costs remain high. Companies that rely heavily on fuel, transportation, or energy-intensive production could face higher operating expenses. Airlines, shipping companies, and chemical manufacturers are often among the industries most sensitive to rising energy costs. On the other hand, energy producers and companies involved in oil and gas extraction may benefit from higher prices. That is why market movements during energy shocks often vary significantly between sectors. Technology companies, consumer goods firms, and financial institutions may experience indirect effects depending on how energy prices influence inflation and interest rates. When borrowing costs remain high, corporate investment and consumer spending can slow, which eventually affects revenue growth across multiple industries. Currency markets are also reflecting these changes. The US dollar has strengthened as investors move capital into assets considered relatively stable during uncertain periods. A stronger dollar can influence global trade by making US exports more expensive while lowering the cost of imports. For emerging markets that borrow heavily in dollars, a strong US currency can create additional financial pressure. Governments and companies that hold dollar-denominated debt must spend more of their local currency to service those obligations. That dynamic can sometimes lead to capital outflows from emerging economies during periods of global uncertainty. All of these factors together create a complex picture for investors. Financial markets rarely move in straight lines during periods like this. Instead, they respond to new information day by day as traders adjust expectations. Right now, the global economy is standing at a moment where several powerful forces are intersecting. Energy markets, inflation expectations, central bank policy, and geopolitical risk are all interacting at the same time. The outcome will depend on how these forces evolve over the coming weeks and months. What makes this moment particularly important is that the global economy had only recently begun stabilizing after several challenging years. Inflation had been slowing, financial markets had recovered from earlier volatility, and many investors believed that a period of steady growth might lie ahead. But events like the current geopolitical tension remind markets that stability can change quickly. A disruption in one critical region can influence energy supply, inflation, and financial conditions across the entire world. For now, investors are watching carefully, evaluating each new development and trying to determine whether the current shock will fade or deepen. Markets may experience additional volatility as new information emerges, yet history also shows that financial systems are capable of adapting. Supply chains adjust, markets rebalance, and economies eventually absorb shocks that once seemed overwhelming. The key question is how long that adjustment process will take this time, because the answer to that question will determine not only where markets move next, but also what this moment ultimately means for the future of the global economy.